Hello traders and welcome back to the Forex Geek where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to be talking about the Ichimoku Stochastic Strategy, which is a powerful combination of two indicators that can help you identify trends, time your entries, and optimize your trades. So if you've ever struggled with false signals or missed opportunities in the market, this strategy could be exactly what you need. So stick around to the end of this video to learn how to use these tools effectively, avoid common mistakes, and take your trading to the next level. So without wasting any much of your time, let's get started. So this is the trading view platform, and I have the Ichimoku Cloud indicator and the stochastic indicator on my chart. So let's get right into it. But the very first step is to explain these indicators before we dive deep into the strategies. So the Ichimoku stochastic strategy is a trading approach that combines the Ichimoku indicator and the stochastic oscillator to identify trends and pinpoint precise entry and exit points. This strategy uses the Ichimoku to analyze market direction and support and resistance levels, while the stochastic oscillator confirms momentum shifts. So for the Ichimoku, I'll explain the Ichimoku and its components. It consists of five components actually, with the most important being the cloud, which is also known as the Kumo. So this is a Japanese indicator, so you're going to be hearing some words, some Japanese words. So this cloud highlights the trend direction and dynamic support and resistance. So when the price is above the cloud, it signals a bullish trend. So when it's below, it indicates a bearish trend. We also have other components like the conversion line, which is a 9 period EMA. Have a baseline also. We have a lagging span, which is the green line. Have the span A and span B, which form the cloud. So then we have the cloud. And the cloud is the most important because a breakout of the cloud indicates trend change. So that is that for the Ichimoku, just a brief overview. And for the stochastic oscillator, it measures momentum and identifies overbought or oversold conditions. Readings above 80 suggest overbought conditions, while readings below 20 indicate oversold levels. Crossovers between the %K and %D lines in these zones often signal potential reversals. Now, these lines are the blue line and the orange line. %K line is the blue line and %D line is the orange line. So crossovers between these two lines actually indicate potential market reversals. So how do these two indicators work together? That's the strategy I'm going to show you in this video. So ensure you watch until the end. So I'm about to show you the strategy. So the first step is to identify the trend. How do you identify the trend? Like I said, we use the Ichimoku cloud indicator. So for a bullish trend, ensure the price is above the Ichimoku cloud and or above the baseline. Remember, the baseline is a red line. It should be above the Ichimoku cloud and it should be above this uh, baseline and conversion lines. We can see that happening here in the charts. Price broke out of the cloud here, indicating a bullish trend starting, and we have the baseline. We have the conversion line being above the baseline. Remember the crossovers. So this indicates a bullish trend which is starting. And we have the confirmation here with the cloud turning from red to green color happening right here. So this indicates that yes, the trend has changed. The next thing to look out for is to confirm the momentum, and we do that using our stochastic oscillator. So once the trend is established, use the stochastic oscillator to confirm momentum. In a bullish setup, look for a crossover where %K crosses above %D. Remember, %K is the blue line, and we can see that happening right here as price was crossing above that cloud, just about the bullish momentum entering the market. We have that happening here also. The %K, which is the blue line, crossing above the %D line, which is the orange line. And this all indicates bullish momentum stepping into the market. Also, you should confirm that this happens in the oversold zone. For example, in a buy trade, for a buy trade, this crossover should happen in the oversold zone, which is below 20. So we can't go with this one, rather go with this one happening right here. It gives it more strength when you see it below the 20 to the 20 level. Except, but you can also use it when it's here. But for added confidence, you should ensure you use the one that's below the 20 level. This one's here, as it signifies oversold levels in the market. And for bearish setups, wait for the percent K to cross below D in the overbought zone above 80%. We'll talk about that when we go for our bearish setups. So now we have this happening right here, just about when price was about to break the cloud. So now we've confirmed that our momentum indeed is bullish. We have that crossover and price is staying around the oversold levels more than it's staying around the price staying around the overbought levels more than it stays around the oversold, showing us there's enough bullish momentum in the market. Now the next step is to execute your entry. For long trades, after confirming both trend and momentum, just like we've done, you just place a buy stop order at the opening price of the next candlesticks after both conditions are met. Also, I would advise that you use your normal support and resistance key levels to also enter. You could just decide to place a buy trade once you've confirmed all of this. You have the momentum, have the break of the cloud, and we have the cloud turning from red to green. So you could just place your entries somewhere around here, just stop loss below the swing low and ride it all the way. But I wouldn't advise that. I would suggest that you use key support and resistance levels. Like we have a breaker block happening right here. You can see this is the key level. So you could just place your buy as price came back to that level. Here was formerly a resistance level and price broke through it. Now it's turned support. You can place your stop loss below the slow and you'll take profits all the way. You could target a 1:2 or you could target a 1:3, or you can also target significant resistance levels in the market depending on where you find your setup. And remember to set your stop loss and your take profit levels. Ensure you also manage your trades all the way as it moves. You set trailing stop loss, or you can also use the cloud as your dynamic support levels. As you can see, price bouncing off the cloud here, this area here. So let's look out for a bearish example so that we can explain better for bearish trades. And you can see here the first step is the break of the cloud. We have price breaking below the cloud happening right here. Now that is the first confirmation for a bearish trade. Now the next is to ensure that the crossovers between the conversion and baseline are also confirmed for a sell signal. We have that crossover happening around here. At the same time, we also have this cloud changing from green to red happening here. So it's about monitoring price action as it unfolds. Now remember, the next step is to look out for your stochastic if it is overbought. This is for a sell trade we're talking about now. Now, as you can see here, we have the stochastic being overbought here, being above the 80 level. And you can see the percent D line being above the percent K line. Happened twice. One there, one here. So as we've seen all of these confirmations, we could just look to take a sell trade at the next candle after all of our confirmations, stop loss above this high, and I'll take profits all the way down 1:2 or 1:3, or we could look for significant support and resistance levels. You can see here was formerly a support level, price broke through it and it's now resistance. So we look to take a sell trade right here, a stop loss below, a stop loss above that key level. You can also see at the same time where we have an our entry, you can see the stochastic confirming it almost at the same time, showing that selling momentum is entering the market. We should also be looking to sell with the big players who are facilitating this sell move to the downside. And you can see this is a 1:2 in and out. Very, very easy and simple. I advise you study this strategy. It's very important and it can help you spot better high probability trades in the market. So right traders, you've come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.